Okay, welcome back. You've got basically the 30 minutes to go for the pre-open session, and globally, it's a strong kind of picture that we have on our hands. The UBS India conference is also kicking off, and on the sidelines of it, we have the top two people at UBS India joining us now to run us through the house view at UBS. Sunil Tirumalai is joining us. He's, of course, India strategist. We have the head of research and also the banks analyst, Vishal Goyal, joining in as well. Gentlemen, great to have both of you here. Thank you very much for your time. Sunil, if I can start with you, I mean, first of all, congratulations and good luck to the conference as you roll it out, and hope to see lots of people. It's always interesting, a conference of views and opinion, etc., that gets exchanged at a forum like this. But tell us, Sunil, how is the setup looking for markets? Can we expect a rally into the end of the year in India and globally as well, especially after what happened with the Fed last week? So there was a distinct shift, and the base case now seems to be, at least with mainstream economists, that the Fed is done. The hiking cycle is done. Go on.
Yes. Thank you, Prashant, and good morning to all the viewers. Yes, I think if you look at globally what's happening, our UBS house view is for a mild recession in the US into 2024. It's not a very deep recession, but we are definitely below consensus in terms of what our economic outlook in the US is. And I think along with that, we have again a reasonably anti-consensus call for a drop in a reduction by the Fed and the Fed funds rate, right? And that's I think the global backdrop. Of course, this year has been fairly volatile, and the U.S. economy has shown fairly robust strength signals. And I think that's been a narrative for the last 3 to 6 months in terms of a higher for longer rates. And I think there are some softness that's also coming into that narrative. I think in that overall setup where the global demand both from the US and from China are looking a bit weakish, I think a lot of the market movements are basically being driven by the market's views on the Fed, on global liquidity, etc. Right. So I think overall, from a relative perspective, if I put on my emerging market strategist hat, I would say in the context of where valuations are globally, where valuations are here in India, it would be a bit difficult for Indian equities to outperform other emerging markets. So we are actually kind of cautious on Indian equities at the moment from an emerging markets context.
Well, that's interesting. All right. So you're cautious on the Indian equity space from an emerging market context. Got it. Vishal, I want you to come in on this, because at the end of the day, every bull market is based on fundamentals and earnings growth, right? How have you looked at earnings season so far? Has it been more hits than misses? And what is your expectation in terms of earnings growth for the full year now?
Yeah, so I think while Sunil will be able to help with more details, I think generally we have seen a downward revision in earnings, especially sectors like financials and even IT. So that is where the earning momentum is generally been negative, or we have seen cuts. In terms of earning expectations, Sunil.
Thank you. Yes. Thanks, Vishal. So I think as Vishal was saying, even this quarter earnings season, we have seen cuts across across sectors. The heavyweight sectors like financials and IT have of course been a bit weakish. I think if you look at commentary from companies as well, I mean, after kind of weak monsoons, we were looking up to see what kind of impact is that having on rural demand, on demand from bottom of the income pyramid, etc. We are still getting mixed signals on that. So I think going into the next year and the year after, consensus is expecting about 14-15% earnings growth. We probably, see some, 3 to 4% downside to those numbers. Is how I would, kind of put it.
All right. Hi, good morning, Sunil, as well as Vishal, and wishing you all the best for the conference. I'm sure there'll be a lot of investor interest out there. Sunil, I want to take a point that you just made about a little bit cautious on Indian markets from the emerging basket. Do you believe that other emerging markets are now looking attractive at these price and valuation points?
That's correct. I mean, let me give you both the fundamental and the valuations perspective to that. If you look at, for a foreign investor, you're looking at earnings and returns in dollar terms. If I take a 4 to 5 year history and the next 2 to 3 years of forecast on consensus of actual EPS growth delivered by each of the markets, the stocks and the indices, India is pretty much in the middle of the pack, right? I mean, it's not really been superlative. So the Indian economy may be one of the fastest growing, but not the Indian stocks in terms of the growth that they're delivering on earnings. But if I look at valuations, India has outperformed significantly. And if I look beyond fundamentals and just what we quantitatively call as the perception or the sentiment score that drives valuations, any random emerging market stock that is plugged today and placed in India, listed in India, is getting a straight 80% increase in valuations, right? That used to be 30% premium pre-pandemic, but because of the pandemic-related flows from households and savings coming into the markets, that's really got elevated to a very significant extent. So you basically, if you look outside of India, there is a tech cycle that's recovering. We are seeing the inventory cycle beginning to improve. There are, positive linkages of real manufacturing relocation hitting numbers in markets like Mexico, in ASEAN, etc. In China as well, the companies have actually delivered really good numbers. It's just that the market has sold off, right? But basically on a fundamental basis, we're actually seeing reasonable strength even outside of India.
Okay, got it. Sorry, Sunil, on the earnings front, you said based on what we've seen, earnings cuts, right? Both Vishal and you said, earnings need to be adjusted by how much? I think you put out a number. I missed that, sorry. 3 to 4% lower.
So consensus is guiding, is expecting about 14 to 15% earnings growth into next couple of years. I think that CAGR number is probably needs to be shaved by about 3 to 4%.
I see. Okay, got it. Vishal, across your coverage universe in India, how many buys do you have and how many sells do you have now?
So I think generally the mix, for example, again, financials, I can tell you from a market cap point of view, it's around 25 to 30% sell within financial, which is on the higher side. I can tell you over the last couple of years. So we are seeing slight increase in the sell proportion, if that is the question.
Okay, Sunil, you have a broader number across the coverage universe here?
I mean, I think as Vishal said, even that holds true for the other sectors too. We are, increasingly seeing downgrades. I think unless our, conscious of the valuations that have, kind of caught up, relative valuations are expensive. So, over the course of this year, we've seen, for instance, the auto sector has done well, and we've turned a bit cautious in some of the stocks. Some of the consumer names, are also the places where we've increasingly been turning a bit cautious. But yeah, I think I would say over the last 6 months, the number of sells and neutrals is higher, holds is higher than has been rising, and there's been a general downward shift, and I think that's in line with valuations. The market has done well, and it's time to kind of slowly start turning a bit cautious.
I want to come back to this discussion on financials, Vishal, because I was going through your report and you do see an increasing default risk in retail unsecured loans. And you say that is likely to push up credit losses by about 50 to 200 basis points. There's also a risk of regulatory tightening, which is quite high. So hence you've turned neutral on the sector. But can you just elaborate on that? I mean, this neutral stance is for how long, and what do investors do in such a situation?
Yeah. Yeah, sure. So see, now to look at the backdrop, for last 3 or 4 years, we are only seeing credit cost decline. And that is on the back of the NPL cycle peaking, and we have seen some lumpy recoveries also in the last few years, which has supported credit costs. Incrementally, when we look at what is the new area which has actually grown in last 5 years, it is unsecured. So unsecured book actually has grown at 27% CAGR for the system, and it's now around 10 to 12% for banks book, and which is the highest we have seen in last 20 years. So that is number one. So the proportion of unsecured itself is higher. Second, we all know that the credit losses in unsecured book is generally higher than the average retail product, just because of the way it is structured. Also, what we noticed, especially looking at the data we've obtained from Credit Bureau, is lending to riskier borrower actually has gone up in the recent few years. So all this actually points to a fact that we would see higher defaults from this particular segment. And so you're right, 50 to 200 basis point is the incremental credit losses we see for this particular segment, and that will push up credit costs, which are at historic lows. So we are back to 2004-5 credit costs. You look at for banks in general, you would see 30 bips, 40 bips kind of credit cost, which is going on, which was only seen last I can remember is 2004-5. So this is also abnormal. We would see a normalization in credit cost. That's our view, and we feel that consensus is not fully factoring in the normalization cycle of credit costs.
Okay, gentlemen, have a great conference. Thanks a lot for stopping by and speaking to CNBC-TV18 ahead of it. We hope to hear from you post the conference as well to get the key takeaways. Let's